Hello everyone and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Mohammed Azim from Traders United. First disclaimer, True webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified elite wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of elite wave theory. In addition to my work as an analyst, I am also an author and educator. I wrote Introduction to Elite Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elite Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. So previous week global market trends. The first one is the Empire State Manufacturing Index USA related to the euro dollar currency pair. That's the focus one. Then we have the unemployment rate related to Australia, and our focus is on Australian dollar versus United States dollar currency pair. So let us start with the first one. What is Empire State Manufacturing Index? Let me explain it. The Empire State Manufacturing Index measures business conditions for New York manufacturers via a monthly Fed survey. A positive reading signals expansion, a negative one indicates contraction. As a leading regional report, it provides an early snapshot of the national manufacturing sector's health. Consequently, it is closely monitored by investors and policymakers to gauge the broader economy's direction and inform financial decisions. Now, the financial event that we got is the Empire State Manufacturing Index. The previous number was minus 8.7, forecast was minus 1.8, and the actual number we got is 10.07. So that's in green. So it's a positive number. And the currency pair we're going to focus is the euro dollar currency pair. Now, the reaction we got is basically the Euro USD currency pair actually moved higher when we got this news that comes out. So here's a chart of Euro dollar currency pair. If you notice, we got a nice bullish rally in Euro dollar currency pair, and this is what I already mentioned as well. So we got a nice rally to the upside in Euro dollar currency pair after the news event. And why we got this? Because we got a stronger data. So that was an unexpected market reaction as far as the fundamentals are concerned. The Empire State Manufacturing Index shocked markets with a stunning rebound to 10.7 number, far exceeding expectations for a mild contraction at minus 1.8. This was the first positive reading since early 2024 and suggested a strong improvement in New York's manufacturing activity. Normally, such a sharp upside surprise would boost the US dollar, reflecting renewed optimism about the USA economic momentum. Yet, in a counter-intuitive move, Euro USD climbed higher, signaling that traders faded the initial bullish US dollar reaction. Now, why did Euro dollar rise up despite the strong data? Well, I would say the good news is bad news for the dollar. Markets may have interpreted the stronger than expected data as reducing the likelihood of further Fed rate cuts, but not enough to trigger fresh tightening expectations. With the Federal Reserve already signaling a wait and see stance, investors may see strong data as prolonging policy stability, not as justification for rate hikes. That interpretation tends to reduce the near term US dollar appeal. Ahead of the release, many forex traders were positioned for a stronger dollar, anticipating an upside surprise. Once the data confirmed those expectations, profit taking set in, pushing the Euro USD higher as short term positions were unwounded. Now, what happened is this was the breakdown over here, and then the break of this trend line. So, last week I already mentioned that we're expecting a possible pullback and a retest around this trend line, and this is what we exactly got right over here in euro dollar. And then market is probably going to start the decline. So as of today, you can see market is falling down. Okay, the U.S. fundamentals, the data reinforced the narrative of U.S. economic resilience, but its impact was partially neutralized by already priced expectations and cautious Fed guidance. As far as the technical overview, the Euro USD I showed you, it took out the support level and then a retest of the resistance level. So the conclusion is while the Empire State Index delivered a major positive surprise at 10.7, the euro dollar's rise underscores a key market truth. The context matters more than the headlines, I would say. When Forex investors believe strong data won't alter the Federal Reserve stance, the good economic news can still lead to US dollar weakness. In the short term, the euro dollar may remain uh, range bound, I would say, but sustained bullish, like if we get it, will depend on whether the upcoming US retails sales, PPI, and jobless claims confirm or contradicts this resilient but steady narrative. The next one is the unemployment rate related to Australia, and our focus is on AUD USD currency pair. So on Thursday, October 16th at 12:30 a.m. UTC time, we got the Australian unemployment rate data report. Now, let's talk about it. What is unemployment rate? Australia's unemployment rate measures the percentage of the labor force that is unemployed and actively seeking work. It is a key indicator of the nation's economic health, reflecting the strength of hiring and overall business activity. The Reserve Bank of Australia, RBA, closely monitors labor market data when setting monetary policy. A lower than expected unemployment rate generally signals economic strength and may lead to a more hawkish stance from the Reserve Bank of Australia, which supports the Australian dollar. Conversely, a higher unemployment rate indicates labor market weakness and may increase the likelihood of policy easing, typically weighing on the AUD and pushing the AUD USD currency pair lower. Now, the previous number we got was 4.3%. The forecast also 4.3, and the actual number is in red because it increased to 4.5%. So the actual unemployment rate rose to 4.5%, exceeding both the forecast and the previous month's figure. This higher weaker reading points to a softening labor market, suggesting that earlier interest rate hikes are beginning to slow hiring momentum across key sectors of the economy. Now, following the release, the AUD-USD moved lower. Let me show you the chart of AUD-USD currency pair. Right over here, this is the chart of Australian dollar versus United States dollar currency pair. So we got kind of a bearish drop over here, but overall it turned sideways. So the decline we got in Aussie dollar currency pair, reflecting immediate selling pressure on the Australian dollar. The weaker than expected unemployment data prompted traders to price in increased expectations of a dovish stiff from the Reserve Bank of Australia in the coming trading months. The market reaction indicates growing concern that the Australian economy is losing steam, potentially prompting the central bank to pause or even consider interest rate cuts in 2026 if the trend continues. Now, the impact that we got is we got overall sideways price action. But if you check out the chart of AUD USD currency pair, uh, this looks like to me we got a nice downtrend over here in AUD USD currency pair. Okay, so the higher unemployment rate is basically bad for the um Australian economy, and it's bad for the AUD. So overall, we got a drop in price action of AUD USD currency pair. This means the United States dollar is becoming strong and the Australian dollar is becoming weak. That's a bearish sign for the Australia and the Australian economy. So this was the outcome of the October report, leading to a decline in the pair. Okay, so the overall analysis is the October unemployment report showed a higher than expected rise in joblessness to 4.5%, confirming that the Australian labour market is cooling more quickly than anticipated. Under normal circumstances, this type of financial data is negative for the AUD, and the corresponding drop in AUD USD reflected this expectation. The higher unemployment rate is obviously bad for the Australia's economy. Okay, and this may strengthen the argument for a policy pivot by the Reserve Bank of Australia in 2026, particularly if upcoming data such as employment change, wage growth, and inflation trends confirm a broader slowdown in Australia's economy. So the key takeaways for the AUD USD currency pair is a higher unemployment rate supports the view that the Reserve Bank of Australia tightening cycle has peaked, and the decline is basically aligned. The decline that we got in AUD USD currency pair, it's aligned with a dovish policy outlook and slower domestic growth. So the conclusion is Australia's unemployment rate climbed to 4.5% in October 2025, above both expectations, meaning the forecast level, and the previous number, 4.3% number. Okay. So the weaker reading fueled a bearish reaction in AUD USD as investors anticipated a more cautious stance from the Reserve Bank of Australia's going forward. While the data underscores cooling economic conditions, the degree of slowdown and the Reserve Bank of Australia's response will determine whether the Australian dollar continues to weaken or stabilizes in the coming trading months. Now, let us take a look at the previous week global market trends. The first one is the euro dollar. Uh, Regarding the euro dollar, I was expecting a bullish leg. We got it. And now, the way I see the price action of euro USD is most likely going to drop more over here. Now, we have this support down over here. Here is a support. Okay. So price might try to find some support over here and then expect a bullish leg from these lows. Now, sometimes market do not exactly hit the support level. Okay, for example, over here, this is another support over here. So 1.1446 or somewhere near to this area, we might get some buyers. Okay, so let me remove this one. So the way I see euro dollar is most likely going to continue the decline. It's probably going to drop a little bit more over here. Regarding the US dollar Swiss franc, we got exactly the bounce right over here. This is what I've told you guys, that USD Swiss franc is going to drop and then it's going to bounce back up. So this is exactly what we got over here. We got a bounce and now expect further upside in US dollar Swiss franc currency pair. Okay, it looks quite possible that market wants to go up. Okay, next let's go over to the uh, current week. Okay, so let me talk about the current week's macroeconomic events and data releases. I will be covering the key developments in Forex market with a focus on fundamental analysis. The first financial news item is the Consumer Price Index (CPI) Y over Y related to United Kingdom, and the currency pair we are going to discuss is the pound dollar currency pair. The next one is the German flash manufacturing PMI related to Eurozone, and we're going to discuss the euro dollar currency pair. So let us start with the first one, the United Kingdom's consumer price index. What it is, let me explain it a little bit. Well, the United Kingdom's consumer price index, also known as CPI, Y over Y means year over year. Okay, it measures the annual change in prices for a broad basket of goods and services. It serves as the primary gauge of inflation. The CPI reflects the cost of living and purchasing power in the economy and is released monthly by the Office for National Statistics. The Bank of England closely monitors CPI trends when determining interest rate policy. A higher CPI reading signals accelerating inflation, which may prompt to the Bank of England to tighten monetary policy by raising interest rates, typically strengthening the British pound. Conversely, a lower CPI indicates easing price pressure and can weaken the British pound as it reduces the urgency for further rate hikes. Now, on October 22nd at 6 a.m. UTC time, we will get the report. The previous number we got was 3.8%. The forecast is 4%. The actual data not yet released. So attention now shifts to the European session where Forex traders awaits the UK Consumer Price Index data for it to be released at 6 a.m. UTC time. This inflation report carries significant weight for the Bank of England as it navigates a delicate balance between slowing economic growth and stubbornly high price pressures. Forex market expects headline inflation to rise modestly to 4.0% from 3.8%. The previous number was 3.8%, driven by higher energy and services costs. Any deviation from this forecast could spark sharp volatility in the British pound and reshape expectations from the Bank of England's next policy move. So the Bank of England faces a challenging environment as inflation remains above target while economic growth continues to weaken. A financial reading in line with or above the 4% forecast would reinforce the view that price pressures remain sticky, potentially delaying discussions around interest rate cuts. However, a softer print closer to or below 3.7% would support the argument that inflation is easing, paving the way for a more dovish tone from policy makers. So the key focus over here is the is the core CPI. Beyond the headline figure, traders will pay close attention to the core CPI, which excludes volatile food and energy components. Core and services inflation remain persistently high, a concern for the Bank of England as they reflect underlying domestic price momentum. A surprise drop in these measures would signal that tightening is effectively working, which could pressure British pound lower. If you take a look at a price chart of GBP USD currency pair, let me go over here and here's a British pound chart over here. Let's remove this trend line over here. It looks a bit sideways, I would say. I can draw a simple trend line like this over here, and then another trend line like this. Let me change the color to blue. So it looks a bit sideways over here, okay, in daily time frame. So we will see how the price action is going to react once the actual news comes out in GBP USD currency pair. A hotter than expected print would likely trigger a bullish reaction in GBP USD currency pair, and Forex market would interpret this as evidence that inflation remains uncomfortably high, increasing the probability of the Bank of England maintaining or even resuming a hawkish stance. Short-term yields would rise, supporting the pound against the dollar. Now, if the CPI is in line with forecast, meaning we get a 4.0% number or somewhere around, then it's on target. That number is on target, and that result may lead to a muted initial reaction. We might get a sideways price action inside GBP currency pair, but the tone of core CPI will determine the next move. If core inflation remains firm, the pound could still find support. However, if it shows signs of moderation, GBP USD might drift lower as forex traders anticipate the Bank of England turning more cautious. And if the CPI is lower than expected, meaning less than 3.7%, that's a softer inflation number, and that would be bearish for the GBP USD currency pair, as it would reinforce expectations that the Bank of England is nearing or has already reached the end of its tightening cycle. This would likely drive yields lower and trigger profit taking on recent British pound strength. So the overall analysis is the market currently expects a slight uptick to 4%, settling up a balanced risk profile for the British pound. However, sentiment leans dovish given recent weak growth data and the Bank of England cautious tone. The reaction will depend on whether the CPI confirms ongoing inflation persistence or hints at a faster cooling trend. This upcoming CPI release is one of the most important economic events for the British pound this quarter, with inflation still well above the Bank of England's 2% target. The stakes are high. A stronger than expected reading, like if we get a 4.1% number instead of a 4%, could revive bets on extended tight policy and propel the GBP USD higher. On the other hand, a weaker print like 3.7% or less than 3.7% number would confirm that price pressures are easing, opening the door for a pound correction. And I would say forex traders should watch both headline, the CPI and the core CPI figures closely, as these will shape forex market sentiment and determine whether the Bank of England maintains its cautious tightening stance or begins signaling a dovish pivot. The next one is the German flash manufacturing PMI related to the Eurozone. Now, what is the German flash manufacturing PMI? The German flash manufacturing PMI stands for Purchasing Managers Index, measures the performance of Germany's manufacturing sector, which Based on surveys of purchasing managers across key industries, it reflects business conditions in output, new orders, employment, and supply chains. Usually, a reading above 50 indicates expansion in economy, while a reading below 50 suggests contraction in the manufacturing sector. Since Germany is the largest economy in the Eurozone, this financial data serves as a leading indicator of overall economic momentum for the region. Stronger PMI reading signal industrial growth and improving business confidence, supportive for the euro, obviously. Whereas if we get a weaker figure or weaker number, that would often point to slowing demand and economic strain, typically weighing on euro dollar currency pair. So the previous number we got was 46.2. The forecast is 46.6. The actual data not yet released. So our main focus is on euro dollar currency pair. And if you take a look at a chart of Euro USD, it seems to me Euro dollar is falling down. Looking ahead to the European session, Forex traders are gearing up for the release of Germany's flash manufacturing PMI, which is a critical barometer of industrial activity for both Germany and the broader Eurozone. The market expects a slight improvement with the index forecast to edge higher to 46.6 from 46.2 number, signaling that while the sector remains in contraction, conditions may be stabilizing. So the Germany's manufacturing sector has been under sustained pressure due to weak global demand, high input costs, and tighter financial conditions. And maybe that was the main reason that we got a bullish rally in euro dollar currency pair. The euro is becoming weak, and the United States uh, dollar is becoming strong if you check out the current rally. But the previous one over here, this is a big bullish leg over here, and it shows some signs of strength in euro. But in last few trading days, we got a top in euro USD, and market is now trying to drop over here. Okay, so I would say if we get a financial number close to the forecast of 46.6, that would suggest the worst of the downturn may be over, supporting the idea that Germany's industrial base is stabilizing and we might get a bullish rally. Okay. So the overall analysis is the Germany's flash manufacturing PMI is expected to show mild improvement, but the index remains below the 50 threshold, indicating contraction in the economy. This sets up an asymmetric risk for the euro. While a small upside surprise could lift sentiment, a weak number could trigger a sharper sell off given the fragile state of the eurozone growth. Okay, and you see the euro USD, it's already going down. So a drop in euro dollar currency pair means that the euro is becoming weak and the United States dollar is becoming strong. Okay, the Germany's flash manufacturing PMI release is a high impact event for the euro, as it offers one of the earliest insights into eurozone economic momentum. If the reading beats the expectation greater than 47 number we get it, it would signal improving industrial sentiment and could prompt a short-term rebound in euro dollar currency, when we might get a bullish leg in euro USD. However, a weaker print like less than 45.8 number would confirm persistent headwinds in manufacturing, likely leading to euro weakness as markets price in greater ECB policy caution. Forex traders should pay close attention not just to the headline figure but also to the underlying survey details, particularly new orders, output, and employment trends for a clear picture of Germany's industrial trajectory. Next, let us take a look at current week global market trends. Let's take a look at euro dollar and US dollar Swiss franc. So euro dollar, the way I see markets probably going to drop. The overall trend was bullish. It still looks bullish over here, but we're getting a drop in price action and euro dollar currency pair. So if you check out the 4-hour time frame over here, let me zoom out a little bit. The trend looks still, bearish. It's a downtrend over here, especially if we get a break below the support level, below 1.1543 level. I expect further weakness in price action. Now, if the euro USD is falling down, then it means expect a bullish rally inside US dollar Swiss franc. And this is what we are getting right now. We got this breakout and the retest of this trend line. So this is telling me that USD Swiss franc wants to go higher. Okay. And if I remove all of this, this looks like to me we got this nice bullish trend line over here. Okay, so there's a nice uptrend going on in US dollar Swiss franc currency pair. Next one is the Australian dollar AUD USD currency pair. AUD USD currency pair, the trend is weak and I expect further weakness in price action inside Australian dollar versus United States dollar currency pair. Next one is the spot gold. The trend was obviously up in gold. We might get some sideways trading range type days, but overall it is an uptrend. So market might try to find some buyers or support once it hit this upward sloping bullish trend line somewhere over here. Okay. Okay, if you have any questions or comments, feel free to type inside the chat box and I will be happy to answer your questions. So let us review what we have learned today. I discussed about the consumer price index related to UK, and we also discussed about the German flash manufacturing PMI related to the Eurozone. What you should do next? Well, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages. And if you want to learn more about trading, visit TradeGeek and access free trading courses for beginners, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, October 28th, 2025 at 12 p.m. UTC time. So that's it from my side. Have a nice day and bye-bye.